what was your takeaway from all what the Fed's Powell had to say, and how does it change your guidance, if at all, looking ahead?
Yeah, we finally got the first Fed rate hike of this cycle. And definitely, as Juliet said at the start, it's been a long time coming. This was pretty well projected from a Fed that's looked to not surprise markets and has really erred on the side of using forward guidance to their advantage. Now, a few things that stood out to me today. First of all, the inflation outlook. We saw that being revised higher, particularly not only for this year, but also for the years to come, as the Fed now sees inflation maybe more entrenched than they did just at the end of last year. Additionally, we saw that they now are expecting an additional 4 rate hikes increases this year, and that's going to end up weighing on growth with the GDP forecast revised down significantly. So we are setting up for a more difficult area where the Fed's going to have to thread that needle between balancing managing inflation while also not suffocating on the growth front.
Exactly, and let's just pick up on that. Is it a case of inflation versus growth where the Fed is prioritizing inflation? And the question I want to ask you really is, are they barking up the wrong tree given the nature of this inflation?
Yeah, it's a great question, because unfortunately the Fed rate hike increases won't do much to address the supply chain issues. Really, the only thing the Fed can do is tamper down demand. And that's exactly what's going to happen as they now look to take the Fed funds rate not only to neutral, but above neutral, with ending around 2.8% in the Fed funds rate. So certainly we're going to see that come through on the consumer growth side. And it seems like at the moment the Fed is content to let that happen. We just saw the montage from Fed Chair Powell, where he mentioned the words strong growth multiple times, indicating that he thinks the economy can withstand this. It's really going to be a careful test, though, in terms of how fast the Fed really wants to move, given there's a lot of moving parts here, particularly with ongoing geopolitical tensions.
Emily, how does it complicate matters for emerging markets, which is your specialty? We've been looking at this rebound coming through in China tech, which is basically on the back of these soothing words from Beijing, but it doesn't take away the geopolitical concerns as well.
Yeah, actually, it's been a really interesting start to the year in the emerging market side, and we've divided it up primarily by region. So really in the Central Eastern Europe area, obviously, unfortunately, the issues around Russia and the Ukraine are front and precedent and sort of right in their backyard. That's obviously been weighing on the economic growth outlook there. On the Asian side, it's actually been China that's been driving the story forward. And as you mentioned in the program earlier, we've really seen an easing on that front when it comes to the policy out of Beijing. And that's certainly a welcome development, given that we've been following the COVID stats and the zero COVID policies and recognizing how that will end up being a crimp on growth. Now, the one area that might actually benefit from all of this is Latin America, where there is more of a commodity exposure still there, but also not as much exposure on the geopolitical side. But even there, obviously, there's still things to consider with the Fed now hiking and starting reducing accommodation going forward.
And of course, we're closely watching what is going to happen with Russian assets when they resume trading as well. Your thoughts there, particularly when we've been seeing wild swings in the ruble?
Yeah, we've been watching the ruble quite closely, and actually, if anything, recently we've seen a bit of a retracement of the dramatic move, although notably the ruble's still significantly weaker since this crisis unfolded. We'll now start to turn to the equity markets, which will potentially open as soon as next week. Obviously, a lot of bad news to be reflected in the price there, given that closed markets still end up reflecting these negative trends and developments. There'll be a lot of catch-up to do on that front.
Russian, the prospect of defaulting on its bonds, that's very much something also in the mix right now. And how does that at the moment look, and what would be the repercussions?
Yeah, it's going to be one of the more unusual defaults in sort of financial market history, given that the primary reason that Russia is unable to pay is because they can't access the sort of being able to transfer the funds to the correct counterparties. There's a lot of implications here, and that where there can have to be a lot of sorting through of financial prospectus and going through with lawyers. But in the meantime, really what it means is that there's going to be higher borrowing costs for Russia for a longer period of time. It's going to be hard for them to return to the market to get financing. And there will likely also be some implications on the corporate side, given that these sorts of things have spillover effects. Definitely we'll see this come through in terms of Russia's economic growth outlook.